You know markets backwards, Tim. Were there any lessons learned from the market action of the last couple of weeks?
To me, it really echoes back. There's a life cycle in the markets just like there's life cycles in stocks. You go from value when things are busted following the financial crisis. You move into a growth mode, and then you get into a momentum mode. And when you're in momentum, you have no room for any disappointments. And in this case, we had rising rates in Europe. We had a little bit of a slow start to the earnings reporting period, and those pins can prick that momentum-driven market very quickly. Now we've reset, and we go back and look, is the growth there? And both in the U.S. as well as in Europe, we think that's a pretty stable story right now.
So now it's a more fundamentally driven market.
Exactly.
But there are many worries still, not least of all the twin deficits, as we're calling them right now here in the U.S. Lots of geopolitical risk in Europe still.
Well, I think if you look at the higher rate situation that's part and parcel of that pin pricking, I think there is a fundamental base from our work about inflation expectations are building. I know you all have talked about that a lot this morning. And it's real. From a bottom-up perspective within what we're looking at Bloomberg Intelligence, look at transportation costs as a case in point. They are rising across all sorts of different aspects that feeds through the supply system of the economy. And employment is quite robust around the globe, et cetera, et cetera. Those things change. We feel that there is an inflection point within that context, within rates. And if rates are modestly moving up, we don't think that there's anything too scary, but it makes sense fundamentally, then you have to have earnings to drive the marketplace. And we're going through an adjustment factor at this point.